we are coming here today with new technical session. As usual, I expect all the participants to be active and be free to ask the question. But I'll request today that since our presentation is vast, covering many areas, I'll request all of you to please put your query in the chat box so far possible, so that we can attend at a time required. So in between, at the end, we may take more questions physically, but in person, but otherwise put it in chat box because today topic is vast. So as regards debt listing, honestly speaking, I don't want to talk much on this. Topic itself is explanatory, but we are covering in this commercial paper and other instrument also. And not only debt listing, but an issue is also where we have taken. And as today we have two panelists with us. One is Mr. Yashesh Bhatt and second Ankur Shah. Yashesh is having 16 years experience in handling corporate secretarial matters. Currently, he is Vice President Company Secretary Compliance with Capri Global Capital Group. He is also LLB and also managed MBA from Jamnanal Bajal Institute. He has handled various fundraising and merger amalgamation activities and many other corporate legal activities. Mr. Ankur Shah is an experienced financial service professional with 15 years of association with bank and BFC. His total experience is over 19 years as company secretary with different companies. He is associated with Aditya Birla Finance Limited as its company secretary since April 2015. He has played instrumental role in two mergers with the company. Over and above, he is also company secretary, also involved in execution leg of treasury borrowing for the program. And for your information, he has experience in issuing commercial paper, so that will be useful to all the participants. As usual, I'll say that we have taken commercial paper also, as people are not well known having knowledge about this aspect of borrowing. And as usual, I'll request Mr. Bala to give 2 minutes introduction on the topic, and then each panelist 2-minute introduction on the topic and their input on the topic. Over to Mr. Bala.
Good morning to all of you.
Good morning, Bala.
I have a pleasure in welcoming you all on my own behalf and also on behalf of Mehta Mehta. Today's subject, what we are talking about, the debt listing. Because debt market is actually one of the very, very important market. If you have seen in the last 1 decade, the debt market has grown like anything. The very vast debt market growth has been witnessed in the last 1 decade. And really speaking, the debt market is actually keeping the economy running. Because who doesn't borrow? Including the government, everybody is borrowing. Because RBI is in issuing the bond from time to time, very long time back, everybody is actually aware of it. And second thing, it has got a lot of facility. It has got a facility for the investors, easy exit route, and also it gives you a fixed income. Really speaking, who are looking for the fixed income because the interest rate on the debt is actually ensured. And from the company's point of view, it is much more beneficial than the equity because the interest payment on the debt instrument is actually tax deductible. That means charged to the P&L account, whereas any dividend payment is actually appropriation of the profit. After the profit, it has to be actually distributed. So this makes the difference. Because of that, the borrowing is actually seems to be less expensive compared to the equity. That is another thing. And really speaking, nowadays the debt listing, the SEBI has actually brought, especially the high value net entities, to have a much better corporate governance in place, much disclosure and transparency, especially the timely disclosure which are actually coming over. And many of us have been investing even in the mutual fund from time to time for various purposes, including the tax saving, etc. and other things. Really speaking, we have two great panelists. I had an occasion to interact with them yesterday. They had a very, very vast experience in handling this debt market, including the commercial paper, etc. and all. So we will have the benefit of those practical experience from these two panelists. With this, I hand over the mic to Mr. Ankur Shah.
Yeah. Hello. Good morning, everyone. Nice to see you all present today. And we are taking away your Saturday, few hours of your Saturday. I will just state one thing. Let it be more interactive. While we are always there to pitch in between, but obviously the experienced views of all the other participants are also most welcome. As I understand, it is always an interactive session when it is held by Mehta and Mehta. Yeah. So over to you, Yashesh bhai.
Yashesh.
Yeah, hello everyone. This is Yashesh Bhatt. So today we have came here to discuss the provisions with respect to the new amendment which has came for the debt listing matter. So see, we are anyways going to discuss this in the presentation that what are the changes from earlier and what is the provision right now. But we need to understand why this debt market is so important. If we look at country like India, our debt market is really a shallow market. It is not as deep as a Japanese or US or a European market. The reason is being not only regulatory point of view, but the habit of Indians and also the availability of the instrument in market. See, that market gives the tremendous benefit from the organization point of view is a liquidity. From the investor point of view is to invest the money and get a fixed rate of interest, as well as the banking system to reduce the burden on the banking system. So that is why debt market is that much important in a country like India. And as a company secretary, it is our responsibility to advise and guide the management that which are the better options. We understand that definitely in the organization, treasury team is a team which take a decision on whether to go for a debenture or to go for a commercial paper or even to go for an equity or right issue. But as a company secretary, if we are expert in our domain, if you are expert in our not only in our legal provision or secretarial provision, which is going to govern the process, but also to understand the market in deep, then we can definitely guide our management and help them to take a better decision. So I just request Harsh to start with the presentation with this.
I will just add one thing. A company secretary is by default also a compliance officer under SEBI, LODR. So the responsibility always lies on us. Yashesh bhai, correct?
Right.
Right.
Over to you, Harsh.
Yeah.
Good morning to everyone and all the panelists. My name is Harsh Modi, and today for the topic for presentation is debt listing. So let's start with the presentation. I'm going to give a brief about what do you mean by debt securities. Debt securities is defined under section 21K of SEBI NCS regulation. That is a new regulation that have came into effect. That is issue and listing of non-convertible securities regulation 2021. Means a non-convertible debt securities with a fixed maturity period. That a security has a fixed maturity period of any number of years, like 5 years, 10 years. A fixed period is there, which creates acknowledges debt. It evidences debt, and it includes debentures, bonds, whether or not constituting a charge on the assets or the properties or not. But there is one exclusion given, that it excludes security receipts, securitized debt instrument, and money market, which are governed as per their own regulations, which are issued by SEBI. Now, we're going to see the benefit. Why would a company go for a debt issue and listing? First, it is very efficient way to raise capital. In traditional fundraising such as banking, finance, and taking loan from bank, it is very tedious process. So issuing debt is very efficient way of raising capital, as the raising debt securities has very low cost and enhanced visibility and company profile. So listing of securities always gives us improves the visibility of the company. The perception of the people is that if a company is a listed company, then it is a good company. Is the basic perception of the people. So it also creates a brand of the company when the company gets listed. It increases liquidity. So listing increases liquidity for small shareholders or debenture holders, those who want to liquidate their shares and want some cash flows. Well regulated secondary trading. The trading and all is managed by the stock exchange and monitored by SEBI. So the small shareholders and investors feel safe that their money is safe. And tax savings, as discussed by Bala sir, issuing debt securities provides tax savings to the company, because interest on debentures is an deductible expenditure in tax. Now we will see debt market.
Harish, this is Shailesh here.
Yes,
Harish,
sir.
would you go back to the previous slide, please? And Dipti, since you want this to be interactive, I think we could take points right away, right?
Okay.
Or no, or would you like us to wait till the whole thing is over?
I take it. It is something you always start with interesting, so let it be.
All right. Harish, you're saying efficient way to raise capital. You're also saying it is simple. I would compare this with a bank loan. In a bank loan, you have to deal with one banker or maybe 2-3 bankers, close the matter. The interest rate may be a little higher than in the case of debentures, but it is efficient. Whereas in the case of debentures, you have to go through a lot of things. Appoint debenture trustees, appoint merchant bankers, do a prospectus, be liable for mistakes if there are any in the prospectus. So while debentures is a very good instrument.
Harsh, please continue.
So let's discuss the debt markets. Debt markets are for issuance and trading of various types of fixed income securities. Fixed income securities may be issued by government, public bodies, statutory corporation, banks, and many corporate bodies can also issue in the fixed income securities. A debenture is a very attractive source of funding in a long-term debt instrument issued by corporates and government to secure fresh funds of capital. So the role of corporate bond market becomes more important.
One minute. There is a question from Nirav. Is it mandatory to have a portion of borrowing by way of other than debt securities? If yes, is there any threshold of borrowing beyond which borrowing cannot be by way of bank loans? Panelist, your comment was there. That's why this question.
As long as bank loan is concerned, there is, for the organization, there is no restriction. You can always have your whole borrowing in form of bank loan. But what will happen? Bank will have a restriction. They will have a sectorial cap. They will have a company cap. They will have an industry cap. And you don't know that the industry in which you are falling, there will be other 100 or 10 companies with whom also bank is dealing with. So that depends on the restriction part. As long as your bank loan is concerned, if you want to start a business, if you are having a 5 crore rupees of borrowing as a total borrowing, you can have full 5 crore from bank loan. It is absolutely your decision. But then you also have to think like that. If suppose that bank is going into a problem, or it's a bank is going through the trouble, like Yes Bank, what happened? They will call off the bank loans. They will ask to return the money immediately. Will you able to return that money immediately? Then you will go to other 5 banks, other 4 banks. If there is a turbulence in the industry, then all the banks will be having those fragile nature that they may or may not come to you. So it is always an intelligent decision to distribute your all the borrowings in a way where you can settle the things easily. However, this is for the company which is not a large corporate. If you are falling under the definition of the large corporate, then whatever borrowing you are doing within last 1 year, it is a mandatory to have at least 25% of the borrowing through debt issue. So my first answer was applicable for all the company other than large corporate. Second will be for the large corporate. I hope your question is answered.
Right.
So we can proceed.
Okay, thanks. Okay.
So there are 2 segments of debt market. Actually, the government securities market and the corporate securities market. In government securities, there are securities such as zero coupon bonds, floating rates, treasury bills, and in corporate market, there are fixed income bonds, PSU bonds, and debentures. So debenture is an instrument this is the definition of debenture. Debenture is an instrument which evidences debt whether or not constituting a charge on asset or company or not. So debentures are classified on basis of convertibility, that is convertible and non-convertible, and on basis of security, they are secured or unsecured. Then a bond is not defined anywhere. So this is the basic meaning of bond. Bond is a debenture, a debt instrument in which an investor loans the money to an entity which borrows the fund for a definite period of time at a variable or fixed interest rate. Bonds can be issued by companies, municipalities, sovereign governments to raise finances, all these bonds are listed on stock exchange so that it can be traded and easily liquidated. So this is the governing framework for the debt listed entity. This Companies Act 13, Company Share Capital and Debenture Rules, the new SEBI NCS regulations, ICDR regulations, LODR regulations, and RBI guidelines. These are applicable for a debt listed entity. So issue of debt securities can be based on two types, that is public issue and private placement. So in public issue, the listing on stock exchange is mandatory, and on private placement, it is optional on the point of the issuer. So it is mandatory pursuant to section 40 of the Companies Act, which mandates listing of public issue. Applicable regulations are for convertible debt securities, ICDR regulations are applicable, and for non-convertible securities, SEBI NCS regulations, which have came into effect in 2021, are applicable. And post the listing, SEBI LODR regulations are applicable. Now let's see the implications of ICDR on a debt listing. So convertible instrument means an instrument by any virtue that converts into equity of the company, and issuer shall be eligible to make an initial public offer of convertible debt securities even without making prior of its equity shares. But there is one proviso here, that provided that it is not in default of payment of interest or principal amount for more than 6 months. That means it should not be a defaulter for more than 6 months. Then it can issue a convertible debt income. So another important point for issuing is that they should obtain a credit rating, appoint one debenture trustee, create the DRR as per Companies Act, and if the asset it is a secured debenture, then assets should be sufficient for principal amount at all times. It should be free from all encumbrances, and whether there is a prior charge holder, then permission from that charge holder is also necessary. And if the premise is also a leased premise, then the permission of the leaseholder is also necessary for that. Then, and convertible instrument cannot be issued for these purposes: for financing, for providing loans, for acquiring shares, for any to any promoter or promoter group. For these purposes, convertible securities cannot be issued. But if the conversion period is less than 18 months, then for above purpose, the convertible securities can be issued. That is for providing loan to promoters or for acquiring shares. Now we are seeing the conversion of fully convertible debentures. So let's, if the conversion price is predetermined at first when they were issued, then it should be done as per the issue terms. But if the conversion price is not determined and the convertible portion,
go a little slow. It's going fast. You are knowing the topic, people may not be knowing. So go slow. Huh?
Okay. So if the conversion price is not determined and the issue convertible portion is more than 10 crores, then issuer is not to give an option to convert. That means then issuer should give an option to redeem even the fully convertible debentures. And if the convertible portion is less than 10 crores, then FCDs can be redeemed as per price determined by the board. Now, conversion of OCDs, that is optionally convertible debentures, if the positive consent is required for conversion into OCD into equity, if no reply or negative consent is there, then redemption shall be done as per the requirements of the holder. And the redemption shall be done within 1 month from the last date from which the option is to be exercised. And now let's see the new SEBI NCS regulations 2021. The SEBI ILDS regulation and SEBI NCRPS regulation shall stand repealed from the date which regulation this come from. That means the old ILDS and the NCRPS regulations are repealed. Now these SEBI NCS regulations are applicable. So the new applicability of these new regulations are on issuance and listing of debt securities or NCRPS by way of public issue, and issue and listing of debt securities by way of private placements, and listing of commercial papers. Issue of commercial papers are governed as per RBI guidelines, and listing of commercial paper is governed as per the new SEBI NCS regulation. So these are the ineligible issuers under the regulations. These ineligible issuers are similar to ICDR, that is, issuer and its promoter shall debarred from accessing the capital markets, and the promoters are of the another company which is debarred or dealing in promoters or directors of issuers in a promoter of another company which is debarred from accessing securities market, then issuer or its promoter is a willful defaulter, or promoter is a fugitive economic offender, and if any fine or penalty is levied and it is not paid, then also the issuer is ineligible. So these are the ineligible issuers. And this is the procedure in short to issue in non-convertible securities. First, application for in principle approval is to be made to stock exchange. Then the second step is enter into an agreement with depository. This agreement is required for demat of shares. Then obtain a credit rating and disclose it in the offer document. Then appointment of a merchant banker and creation of DRR. Then display of draft and final offer document on the website, and file with stock exchange and SEBI at the same time. Then filing of offer document with registrar of companies. This is one of the most tedious tasks in the entire issue procedure. Then make an advertisement in one English newspaper and one Hindi newspaper in the where the registered office of the company is situated. And if the minimum subscription as per issue is not received, then all the money is to be refunded to the applicants, and if not refunded, then interest to be paid on that.
So it's almost similar to our shares only listing kind of.
Yes.
Yeah. So, ma'am, this was more for the public issue of NCDs, just a small addition, basically. The slide which we saw.
Yeah.
Yeah, Harsh.
DRR is to be created. Then DRR is to be created as per the Companies Act 2013, that is section 71, and rule 18 of share capital of debenture rules. The DRR should be created out of the profits of the company, which are to be available for payment of dividend. Then the amount credited to such reserve shall not be used for any other purpose except for redemption of debenture. So this is the quantum of DRR that is to be required to be created. These slides is only for a reference purpose. So now we'll be seeing self-prospectus.
Keep that slide first. Just read it out a little bit.
Okay, so for all India financial institutions, no DRR to be required for public as well as privately placed instrument. For financial institution, DRR shall be applicable to NBFC registered with RBI, and listed NBFCs and housing finance companies, for them also no DRR to be required for public as well as privately based. For unlisted NBFCs and housing finance companies, DRR is required only in case of private placement of debentures. And in listed companies also, no DRR to be required for both public as well as privately. And for unlisted companies, the adequacy of DRR is 10% of the outstanding debentures.
So basically, for listed, it is observed that listed.
Now we'll be seeing the provisions of the shelf prospectus that are given in the NCS regulation.
Right.
So,
Yeah. So, ma'am, for basically, yeah. So basically, for NBFC and housing finance companies, money is the raw material, and it indirectly answers what Shailesh bhai also said. Why? So, sir, it is just an avenue, as Yashesh bhai had also stated, a different avenue, because in tough times, you have to have different sources from which you can raise capital, rather than limiting your business. As far as this NBFCs and housing finance companies are concerned. and that's why there is no DRR requirement for them.
Silpa, your question is already answered in,
Harish,
in case of listed company.
Harish, what is the highest amount of
Yes,
DRR
go ahead.
creation? What is the highest amount that is required to be created? Percentage? You said 10% for somebody, but are there higher percentages?
So
Sir, 15% is required to be maintained at all times. That it should not be
sir, this
below 15%. 10% is the
Can you go back to that? Can you just go back to that slide, please?
What Harsh is trying to explain is that in case you have a debenture, suppose A series having 100 crores, next year 25 crore has been redeemed, third year further 25 crore has been redeemed, then that 10% is required at any point of time as on last 31st of March. For example, in the next year, if the 25 crore is redeemed and now it is only 75 crore, then that 10% will be calculated on 75 crore.
No,
on
no.
the third year, it will be calculated on 50 crore.
Mr. Bhatt, I'm not on that. I'm not on that. Yeah. The last item says 10% of the value of outstanding debentures. So this is in the case of unlisted companies. In the case of the other companies which are mentioned above earlier, is the percentage different? Is it 15%, 20%, or what is it? I'm not saying for each, but is it more than 10% for others?
No, they are the same. 10% or same. In most of the cases, no DRR is required. For other companies, for the unlisted companies, DRR is required.
Only for unlisted companies, DRR is required, and that will be 10%.
Unlisted companies other than the NPSC and also the housing finance corporation. Because if you see 3B, it is very clearly saying NBFC and also housing finance also unlisted. So in those cases, the DRR is not required. That is what it is there. So the last column, that is 4B unlisted companies, excluding those two.
Yes, that is right.
So you can conclude for unlisted companies other than NBFC and housing finance companies, DRR is mandatory. Yeah. And for unlisted company, even though it is a housing finance company or NBFC, if they are going for public issue, then it is mandatory.
Correct.
So you can conclude these 2 points with the help of this chart.
Yeah.
Okay. But in no case, it is more than 10%.
Yeah.
It is always a 10% of the value outstanding.
Value outstanding. Yes. Okay.
So now we are going to discuss the shelf prospectus. Issue of debt securities through shelf prospectus. Shelf prospectus is issued when an issuer wants to make multiple issue in a year. So the validity of shelf prospectus is 1 year, and if an issuer wants to issue for a second time, then it does not need to file an prospectus again. An information memorandum needs to be filed with the ROC. For subsequent issue, the information memorandum that is filed for the subsequent issue shall have all the changes that have taken place in the financial position of the company that has occurred between the first offer of securities of the previous offer and the succeeding offer. So information memorandum is to be filed in form past 2. So a shelf placement memorandum, this is issued in case of private placement of shelf issue, and in public issue, in case of public issue of through shelf mode, then shelf prospectus is filed, and in private placement, it is called a shelf placement memorandum. In public issue, it is called the information memorandum is filed, and in private placement, a tranche placement memorandum is filed. So they have different names. The meaning is same. And the eligible issuers for issuing securities through shelf prospectus are public financial institutions, issuers of tax-free bonds as notified by CBDT, and infrastructure debt fund, that is NBFC regulated by RBI, and other.
So in the meanwhile, if Harsh is not around, there is one question raised by Mr. Prasenjit Guha. So his query is, can I have the liberty to just answer that quickly?
Yeah, sure.
Yeah. So
Yeah,
his query is related to privately placed debentures or NCDs. If a company wishes to get exemption from applicability of public deposit rules, listing of PPD are treated as exempted deposit is the correct understanding. So I will refer to the MCA rules of acceptance of deposit. In that, the exempted deposits, this subclause 9, what they are sitting in, if case the company issues a secured debentures and they are secured to the extent of more than 100% of the face value, they are exempted from being treated as a deposit. So meaning thereby it will not be treated as a deposit for the company. And the second is in case of there is a liquidity available. Yeah, in case of listed PPT, there is liquidity available to debenture holder in a practical scenario in the BOSIs to give an exit mechanism. So frankly, it will depend upon the company. The main reason of them being listed is to give an exit, but trading is depending on company to company. Frankly.
So what is the question exactly?
See, the first question was exemption from applicability of public deposit for the NCD issued. Second was liquidity available for listed NCDs.
Okay,
especially private placed. Especially private placed.
As long as your first question is concerned, for the public deposit rules, there is a specific items are given. Secured debenture is exempt, unsecured debenture is not exempt. Because it is not specifically given in the list of exemptions. So whatever is not exempt will be treated as a public deposit. Means you have to follow the provision of public deposit prior to 1 month. You have to file specific form with ROC and comply with all the formalities. That is a simple interpretation. And what was your second question?
In case of listed NCD, whether liquidity is available on the stock exchange.
In case of
listed NCD, whether liquidity of those NCDs is available on the market.
See, that depends on the organization. If you will have a listed NCD of Reliance Industry, you will definitely have a liquidity. But if you have a listed NCD of some XYZ, जो organizations का भी कोई भरोसा नहीं है, maybe after 5 years रहेगा नहीं रहेगा, then you will not find with the liquidity. It is just like equity market. Attractive stock will be those stocks where companies are good companies. Good companies from net worth point of view, capacity to pay back the debt point of view. Because see, in equity market, what happens? You can buy, you can sell, you can have 100 profit also and 0 loss also. But in debt market, your return is determined. Your coupon rate is determined. So it is not going to happen that your price will increase by 100 times or 10 times. You know what is the exact amount you are going to get at the time of redemption. And you also know what is the exact return you are going to get in form of a coupon rate. So basically the only thing which attract the debt market or the specific debt security is nothing but the capacity of the company to repay.
Right.
Okay. I think Harsh, you can take a balance question is on secretarial compliance. Let the presentation carry out, then we will take it. Okay.
Yeah, sure.
Harsh, you can carry it. And then meanwhile, we can take that question of whether a private company can issue the NCD. If yes, what are the provisions and conditions applicable distinctly? Only first question you can answer, panel. Yes.
Yashesh, you will share.
Private company can go ahead with the private placement. No, that is not an issue.
Correct.
Okay.
I only think that one ROC form has to be filed for private company for the first time only. Madam, we have that certificate of a commencement of business. So in a private company, that is not applicable. So there is something in lieu thereof. That form has to be filed the way I recall for a private entity, that too only one time, because it is the first time we are, issuing to other than members, basically. Yeah. And for private company, again, this acceptance of deposit rules. Exception of deposit rules have to be considered so as to not being covered under that. So meaning thereby, as it was stated earlier, secured debentures can be issued. Yeah, and being a private placement, there will be limitation on the number of individuals who can participate in a financial year, which is 200, if I'm not wrong. Yeah, for NBFC, which is a private entity, the RBI guidelines also will be applicable over and above the Companies Act.
But does it mean that a private limited company can only make a private placement? It cannot make a public issue of debentures.
Sir, the articles will restrict, transfer of securities.
The act itself will restrict. Because
yeah, correct. So,
a private company.
Private companies will be restricted by the Companies Act and as well as the articles.
Yeah.
For
So
public issuance. For public
private
issuance.
companies can only do private placements.
Correct.
Correct, sir.
Right.
Yeah, you're right.
Mr. Ramana, I think, has raised the hands. Mr. Ramana? You can unmute yourself and ask the question, Mr. Ramana. I think he's not there. We'll ask him. Harsh, you can start now. Continue.
So for all these entities, these criteria has to be satisfied. And now we are going to see the framework for enhanced borrowing for a large corporate. In 2018 budget, it was announced that to develop a corporate debt market, that was announced to develop a corporate debt market. So SEBI, to operationalize that, has issued a framework for large corporates to borrow money from debt markets only, that is 25%. So let's see what is the framework. So a large corporate means a company having its securities listed on specified securities or NCRPS listed on stock exchange, and having outstanding borrowings of more than 100 crores and having a credit rating of AA and above. So if all these three conditions are satisfied, then only a company qualifies to be a large corporate. So this framework is only applicable to a large corporate. So outstanding long-term borrowings, that means, and borrowings which have original maturity period of more than 1 year. And the most important thing is it excludes ECB and intercorporate borrowings between parent and subsidiaries. So
basically, large corporate is that listed debentures, 100 crores, long-term borrowing of 100 crore or above, AA rating, and it excludes ECB and in the ICD. Yeah. Okay, carry on.
So this is the framework. It is simple that an LC shall raise minimum 25% of its incremental borrowings during the financial year by way of issuance of debt securities. So what do you mean by incremental borrowings? A borrowing done for a period, for a particular year of original maturity period more than 1 year, whether such borrowing is taken for refinancing or repayment of existing debt. But the most important, it shall exclude ECBs and intercorporate borrowings between a parent and a subsidiary company. So in short,
Shailesh, yeah, sorry, Harsh, just a second. So Shailesh, this will answer a little bit why NCDs are being, looked into more category by SEBI and promoted by them to reduce the burden on the banking system altogether. And again, the applicability is only for entities having outstanding debt of more than 100 crores, as I and Yashesh have stated in the beginning, sir, on your question.
Yes, but this is by way of a compulsion. If given
Correct,
the
sir.
choice, I think
Yeah.
the advertisement which is required to be done, the preparedness that is required in the case of a public issue of securities. It is much simpler if you go to a bank. That is my humble opinion.
But
So, sir,
I think Shailesh bhai,
No, we'll close that topic. Dipti,
no. Bank borrowing cannot be with the public issue. It can be with the private placement. You have to compare. It can be public issue.
No,
So
no,
you
no, no,
compare private placement.
no.
Yeah, of course.
No. What I'm saying is that borrowing through by way of public issue of debentures is not really a very, very simple method. It is complex.
What about private placement?
And borrowing from a financial institution or a bank is a simpler process. However, SEBI has introduced restrictions and compulsions for large corporates. Hence, you have to do it. But given the choice,
I'm telling Shailesh bhai, borrowing from bank should be compared to private placement of debenture, not the listing debenture.
public issue of NCD.
Public issue. So
Shailesh
it's a
bhai,
vast,
Shailesh
and
bhai,
as compared to that, it is good.
Shailesh bhai, another thing is there, when you go to the bank, there is always a restriction of the amount of the borrowing. Because if you want to borrow the larger money, the bank cannot give you the larger money what you want, which you can get it in the public issue, really speaking.
again, there's a restriction.
Public
on the
issue, you
dividend
can
that
go
you
for
pay.
1,000 crore, 2,000 crore.
Anyway, we are getting stuck on this topic. Let's proceed, please.
Okay, Harsh, go ahead.
so these are the disclosure requirements on stock exchange that are to be given by large corporate. That is, within 30 days from the beginning of the financial year, they have to disclose the fact that they are identified as large corporate or not. And within 45 days from the end of the financial year, they have to disclose any incremental borrowings they have taken or they have not taken. They have to disclose that. Another thing is that the disclosures shall be certified by both the CS and the CFO of the large corporate.
So the basically the within 30 days limit has just beyond that page is the first one is nothing but the giving confirmation that yes, I am large corporate.
Yes.
Second one is basically compliance is once I am large corporate, whether I would comply with this particular thing or not.
Yes, sir.
Part A and part B of circular. Harsh, you can proceed now.
So the compliance, this is the compliance by a large corporate for financial year 2021. They have to comply on annual basis, and from financial year, actually there's a mistake. The 2022 onwards, they have to comply over a block of 2 years. So this framework was implemented in a stage wise. So for 2021, they have given in annual basis that the incremental borrowing we complied on annual basis. From 2022 onwards, they have given a block of 2 years. Within 2 years, the company has to issue debt securities through debt markets. That is 25% of the incremental borrowings over 2 years. So, but and if also there is a shortfall that the borrowings that are required from the debt market and the company has borrowed less money from the debt market. So the shortfall which is there, penalty is levied on that shortfall. That is 0.2% of the shortfall. That is, let us understand this better with an example. So there's a company, say XYZ Limited, which is identified as LC on 31st March 2022. And if the board proposes to borrow 500 crores, so let's say these are the incremental borrowings by the company. So as per the framework, 25% of 500 crores to be borrowed from the debt market only by issuance of debt securities. That is 125 crores. But the company, say, has borrowed only 25 crores. So there is a shortfall of 100 crores. And these are to be complied in a block of 2 years, that is 2022-23 and 23-24. So till 31st March 24, the company has to borrow 25% from the debt market, and the penalty is levied on the shortfall. So in this example, a shortfall is there of 100 crores. So 0.2% of the shortfall, it is 100 crores, rupees 20 lakh penalties is levied by the stock exchange. So
is this not unfair? If my company is not doing well, I'm a large company, I'm not doing well. If I make a public issue, nobody is going to subscribe to it, and then I'm saddled with a penalty. If against this, I may be able to convince some bank officials, so the banks, that give me a loan, charge higher interest, but give me a loan. This penalty business which SEBI has introduced of 0.2%, I think is okay for companies which are doing well, but not for companies which are making losses, but still are large companies.
See, there are two things in this. First of all, there is not a mandatory requirement that you will go for only public issue. They are talking about debt security. So debt security can be private also. That is point number one. In debt security, if you go for a private issue, bank can invest. That is the first statutory provision.
That's a very important point.
Okay, that is number one. Yeah. Number two, which is even more important because it talks about the spirit of the law. See, we need to understand one thing, that government doesn't want company to constantly become sick. We don't need more Vijay Malias in country. So they are saying that if you are planning to raise 100 crore rupees, then please raise 25 crore either in private or public placement in debt market also. And if you cannot raise it, then please try to understand that you are taking only banking money. You are creating pressure on the banks. Ultimately, this creation of pressure on bank will not lead great success for the nation. So this extraordinary pressure on bank to feed all these organizations which are not suitable to run the business in long term is also not a great idea. So this is a very high level of intelligent decision created by government by putting this particular provision. At least according to me.
But Mr. Bhatt, they could have placed a restriction on the amount of borrowing. Why put a penalty? You can say that you can borrow only so much from the banking sector or from the. Why put a penalty of this amount?
See, if you start putting the particular restriction on the banking amount, then that amount has to be linked with some particular base. There cannot be like 5 crore, 10 crore, 50 crore, 20 crore. So if
Correct.
people will start putting a restriction which is connected to some particular base, then that base is also required to be defined, which is not at all easy to define. I cannot say, for suppose some business which is currently a 200 crore business, if that business is having plan to become 500 or 1000 crore business in next 3 years, I cannot restrict their growth. If government will
No, no,
start
no.
restricting the growth,
What
see,
I'm
that's
saying
what I'm
is,
saying. That's
what
what I'm
I'm
saying.
saying
If
is,
government, Nini, I understood your question. Please listen to me. What I'm saying is that if government will start restricting the business house from taking the borrowing from bank or any particular mode, so then it will start restricting the growth of that particular organization, because different organization will have a different thought plans for next 5 years, 10 years. They will have a different vision and mission. So there cannot be a structure where they will say that ki bhai isse zyada aap bank se nahi le sakte.
no,
So
no.
ultimately they are saying that only. If you look at this particular provision,
My point, Mr. Bhatt, I must
Hmm.
interrupt. My point, Mr. Bhatt, is that the presentation says fine of 0.2% of the shortfall in the borrowed amount. So 0.2% of the shortfall, there is a shortfall. This shortfall has been explained in the circular. So what I'm saying is, instead of having a penalty of 0.2% of the shortfall, say that this shortfall has to be made good only through securities and not through the public sector banks. Why put in 0.2% penalty? Say that this shortfall, which will be explained, that shortfall cannot be made good through bank borrowings or institutional borrowings. It has to be through securities. Remove that 0.2%.
We can do one thing. We can give this suggestion to the regulators. Whenever next time they will come up with any particular guideline, we will give this suggestion. It's a good suggestion.
Thank you.
We can give this suggestion to the regulators. So now we can
And
proceed.
yeah, can I have my 2 words on this?
Yeah, please.
Please.
Yeah.
Yeah.
So sir, Shailesh sir, I will give you a little more background.
Yes.
Now, on the point of borrowing from a bank, I will tell you what will happen. The loan agreement or the facility agreement and the security will have to be dependent on every bank, which will be different, unless you have a large consortium and you appoint a security trustee, and then you create security in favor of the security trustee on who will be acting as a trustee for the banks. Now coming to the point, the security trustee is nothing but a debenture trustee for a private placed debentures. Number one. Sir, number two, what is happening, I will tell you. Bank, because of their own internal trouble, government issues and all, are also little hesitant and reluctant in extending loans to even corporates nowadays because they are made personally answerable. This is a little unfair on the employees.
Yes.
By this privately placed NCD, the market is open to, I will give you 3 very big players. One is the mutual fund. Now mutual fund, by their very nature and private and the level of employees they will employ, will definitely do more due diligence than what a bank, because of their inherent legacy, will be able to do. Not demeaning any bank per se, be it a PSB or a private bank. Number one. Number two is the private provident fund trust, gratuity funds and all that. They are very big players, sir. And beyond that, we also have corporates and high net worth individuals who are giving money not only for NCD which are secured, even for CPs. Sir, the market has grown very, and see, sir, basically what SEBI is trying to do by this regulation, they are making mandatory disclosure so that it is become easier for a mutual fund or a HNI or a private provident fund trust to have a minimum basic information available for all the issuers in a private place NCD. So by this, we are just broad basing our entire debt capital market, which is the idea of SEBI since I think now 20 years. Yashesh bhai will agree with me.
That's a very good. That's a very good idea. It's very good intention, deepening of the market. Only thing,
Correct,
as Mr. Bhatt said, remove that 0.2% as a penalty. Everything else is fine.
Yeah, and we just had a small question. The meaning of incremental borrowing. The incremental borrowing is borrowing during a particular financial year, excluding borrowings by way of ECB and ICD, which I hope I have answered that.
Shailesh bhai,
Aji.
one thing is there. In India, everything works only with what you call deterrent. If there is no deterrent, no compliance is there.
Right, sir.
Let us also remember that.
Right, sir.
When you are talking penalty, while agreeing with you, everything what you have said, but the problem is in reality, unless you put some deterrent things, complaint does not work.
Correct. Correct.
So that is the purpose why the regulator has put this deterrent. And yes,
There is a question to whom is the certification is to be given to stock exchange, certification of large corporation.
Yes,
Stock
yes.
exchange or SEBI.
Stock exchange.
To whom? Right.
Stock exchange, yeah.
If NCD gets listed on 2021, from which year LC regularization will applicable?
I think it is the moment that outstanding borrowings crosses 100 crores, irrespective of it is from a bank or a NCD. As on 31st March of any particular year, the moment your outstanding borrowings from a bank or a NCD, but it excludes ECB and ICDs from Holdco. That day, the company becomes, on that 31st March of a particular year, the company becomes a large corporate.
Further to your answer, the question is, do bank borrowing constituted by charge also come under incremental borrowing?
Yes. So for
Is
every
it
new, so basically for every new 100 crore raised in a particular financial year, 25 is the minimum which should be borrowed by way of a NCD, be it private or be it public. The rest 75% can be from a bank. Can be.
Is it compulsory that incremental borrowing should be listed?
No, I don't think so. Yashesh bhai?
Basically, those 25% should be from the debt securities, and remaining listed or unlisted doesn't make difference. It should be
Exactly.
a debt securities.
Correct,
Okay.
correct. So listing is not compulsory.
Remaining 75% can be any of the mode, the pool of which is going to create eligibility of 100 crore.
Okay.
Yeah, and just to add,
Okay.
though it is not mentioned, if you have a cash credit line or a working capital demand loan from a bank, that will also not be constituted as a bank borrowing because the maturity is less than 1 year in both these instruments. This is more particularly applicable for NBFC and housing finance companies. So any debt which is less than 1 year of original maturity will not be considered as an incremental borrowing. So we have leeways basically.
Okay. Again, can a private company issue NCD to individual who are not shareholders?
I think the acceptance of deposit has to be looked into. That's all. Of Companies Act.
Yeah. We answered
If it is secured, then secured and private placement, it is absolutely fine. If it is unsecured, then it will not qualify under the public deposit rules. You have to comply with those rules also.
Yeah, and I think the individual has to give a certificate, if I'm not wrong, he has not borrowed this money for investment in NCD. It is his own funds. I'm not very sure, but had read it somewhere.
Yes,
Right.
I think it is
for directors. That is for directors.
Achha, only for directors. Okay, my
Yes.
bad. Sorry.
Here's Mehta Mehta on the penalty, just suggestion to remove hardship while doing due diligence for granting loans. Bank may check the level of borrowing, debt security. Okay, he's giving comment. Again, bank and debenture comparison is going on. Sellers by read the chat box. Okay.
No, I'm unnecessarily interrupting. I think we are taking the discussion on a wrong track.
Hers is in
No,
tension.
not at all.
Doing the slides. Hers, don't take pressure. We will finish it up. Go slow and relax. Don't take pressure because the presentation is long. So he's worried whether it will be over. It will be over. Don't worry.
don't worry. I think everything will go well.
Okay.
Ramanamurthy, your hand seems to be raised still. Are you there? Ramanamurthy?
I think that could have been a mistake also by error.
I think so. Hers, you carry on.
Okay. So now we will see LODR implications on a debt listed entity. So there has been amendment pursuant to 5th Amendment regulations. There has been inserted section regulation 15(1)(a) has been inserted, which talks about the applicability of the corporate governance. So there has a concept has been introduced, which is of high value debt listed entity. So a listed entity which has its non-convertible debt securities and has an outstanding value of listed non-convertible debt securities of rupees 500 crore and above. So if this condition is satisfied, then an entity is called as a high value debt listed entity, that is of rupees 500 crores outstanding debt security. That is to be determined as per the principal outstanding of the debt listed as on 31st March 2021. So this is in brief the applicability of LODR on debt listed entity. So if a outstanding value of listed non-convertible debt securities is rupees 500 crores and above, that is entities and high value debt listed entity, then corporate governance norms, that is regulation 16 to regulation 27 are applicable, and along with that the chapter 5 of LODR, which has been specifically for which has obligations for non-convertible debt securities entity. And if the outstanding value of listed non-convertible securities is below rupees 500 crores, then only chapter 5 of LODR is applicable, that is obligations of a listed entity which has its listed non-convertible securities. So this is the applicability of LODR. So now the corporate governance norms are applicable, that is regulation 16 to 21. So the timelines has been given to comply with that corporate governance norm for high value debt listed entity as on 31st March 2021. They have to comply. They have to comply till 31st March 2023, and it is mandatory from 1st April 2023 on comply or explain basis. For a listed entity which subsequently becomes a high value debt listed entity, then the obligation to comply is within 6 months from the date from which the listed entity becomes the high value. And from there till 31st March 23, it is optional, and it is mandatory from 1st April 2023. So comply or explain means that entity shall endeavor to comply with all the provisions, that is corporate governance, by 31st March 2023. And if in case the listed entity is not able to achieve full compliance with the provision, till such time it has to explain the reasons for such non-compliance or the reasons for partial compliance. And this disclosure is to be given in the quarterly corporate governance report that is being filed quarterly. So this is the meaning of comply or explain. So in short, till 31st March 2023, the high value debt listed entity has to comply with the corporate governance norms. It is not that they have to comply. If in case there is non-compliance, they have to state the reasons for that non-compliance till 23, and it is mandatory from 1st April 23. Then giving reasons will not suffice. They have to comply. Then penalty would be levied after 1st April 2023.
But in short, till 31st March 2023, the companies have been actually given to become fully compliant. If there are no compliances or partial compliances, they have to explain, and probably they have to tell them when they will be compliant, but they are expected to be compliant by 1st April 2023 onwards.
Yes,
so that means the time is actually given to them to ensure the compliances during this particular period to achieve the 100% compliance.
Okay. Let's go ahead.
So these are the immediate action points that a high value debt listed entity has to take into action. That is, they have to align their composition of board as per regulation 17 of LODR, which talks about the composition of board and the obligations of the board. Then they have to form various committees as per LODR. They have to draft various policies, and the related party transaction has to be taken as per the regulation 23 of LODR. Then there are certain obligations with respect to independent directors that also they have to fulfill. And another thing, they have to file a corporate governance report within the end of each quarter. So they have to form the committees, that is composition, independent directors, the chairperson, frequency and quorum as per the given table. That is, for audit committee, there has to be at least 3 directors, 2/3 should be independent director. And if a company has issued superior rights equity share, then all the members shall be independent director. The chairperson of the audit committee shall be independent director. The audit committee shall meet at least 4 times in a year with maximum gap of 120 days between the meeting. And the quorum should be minimum 2 directors or 1/3, whichever is higher, with at least 2 independent directors in presence. And the composition of NRC shall be at least 3 directors, and all the directors shall be non-executive directors. And 2/3 of the directors shall be independent directors, and the chairperson should also be independent directors. And the frequency of meeting of nomination committee is at least once in a year they have to meet. And the quorum is same, that is minimum 2 directors or 1/3 of the members, whichever is greater, with at least 1 independent director in presence. And in case of a stakeholdership relationship committee, the composition is at least minimum 3 directors with at least 1 independent director. And if the company has issued superior rights voting share, then at least 2/3 shall be independent directors. And the chairperson should be a non-executive director. Frequency of the meeting of stakeholdership relationship committee is at least once in a year. And for the quorum, it is not mentioned in the regulation, so it would be as per the terms of reference. Then of risk management committee. First of all, risk management committee is applicable to only top 1,000 listed entities. So the composition shall be minimum 3 members. Your member is that, and the majority should be from the board of directors. That is, in risk management committee, the senior level members, senior level employees can also be members of that, but the majority should be of board. And at least 1 independent director should be there. And if the company has issued superior rights voting share, then at least 2/3 shall be independent. And the chairperson should be member of the board. And the frequency of the meetings is at least twice in a year. And the quorum would be 2 directors or 1/3, whichever is greater, with at least 1 member of board should be in presence. And as below, risk management is applicable to top 1,000 and to a high value debt listed entity. So as per this table, the high value debt listed entity should form its committees by taking into consideration all these points. And these are the policies that are to be drafted by a high value debt listed entity. That is risk management policy as per the regulation 21, vigil mechanism policy, related party transaction policy, and material subsidiary policy. So all these policies are to be drafted by high value debt listed entity. Vigil mechanism policy is policy for to protect the employees from victimization. Related party transaction policies is also to be drafted. Who is a related party and what transactions should be covered, and approvals are all to be included in related party policy. And other important points would be it should submit a disclosure of related party transaction on consolidated along with consolidated financial statements for half year. Then secretarial audit for material unlisted subsidiaries incorporated in India. That is to undertake the secretarial audit of the material unlisted subsidiary. Then this is another important point, that to undertake D&O insurance for all its independent directors. Previously, D&O insurance was applicable to top 1,000 listed entities only. Now it is applicable to a high value debt listed entity. So they have to undertake D&O insurance for the independent directors. And
one more thing, Harsh, sorry to interrupt. As long as D&O insurance is covered earlier, it can be taken by the company directly. But now it is a mandatory requirement that the quantum of D&O insurance and the risk involved in D&O insurance has to be reviewed and approved by the board of directors. So now this is a mandatory to take this as a board agenda item, which was not there earlier. It is effective 1st April 22.
Yes, sir.
Okay, thank you.
Then they have to submit a quarterly compliance report on corporate governance within 21 days from the end of each quarter. And they have to submit a secretarial compliance report within 60 days from the end of each financial year. So all of these 5, they have to comply.
And Harsh, one more addition, we also have to have a board diversity policy in the policy part.
Yes,
it is in the schedules of the NRC charter, basically.
Right,
Terms and reference. Board diversity policy.
Right.
Yeah, Harsh, carry on, carry on.
And these are the disclosures to be given in the annual report that are related party disclosure. But this related party disclosure is not applicable for listed banks. Management discussion and analysis, corporate governance report, and the declaration signed by CEO stating that the board of directors have affirmed to the compliance of the code of conduct. Then a compliance certificate either from the auditor or a practicing company secretary regarding compliance of conditions of corporate governance shall be annexed to the director's report, and the disclosure with respect to demat suspend account. So all these disclosures are to be given in the annual report of a debt listed entity. So this is the submission of financial reporting to stock exchange by a debt listed entity. The reporting is quarterly basis. So for first 3 quarters, that is from quarter ending June, September, and December, they have to submit the quarterly financial statements within 45 days from the end of the each quarter. And for the last quarter, that is quarter ending on March, they have to submit it within 60 days from the end of each quarter. So they have to submit quarterly financial statement as above, and the approval authentication of the financial results shall be the unaudited financial statement shall be accompanied with the limited review report that is given by the statutory auditor. The quarterly results shall be taken on record by the board and has to be signed by managing director or the executive director. If any modified opinion is there in the audit report or the limited review report, then it shall be appropriately and adequately addressed by the board while publishing the account for the said period. So submission of annual financial statements, if there is a modified opinion, then statement of impact of audit qualifications need to be annexed to the quarterly statements. And if there is an unmodified opinion given by the statutory auditor, then a declaration is to be given that there is an unmodified opinion. So that declaration is to be given to the stock exchange, and submit a statement of statement indicating the utilization of issue proceeds within 45 days from the end of the each quarter. And in case of any material deviation is there in use of issue proceeds, then same shall be indicated. Then these are the prior intimations that have to be given to the stock exchange by a debt listed entity. So at least 2 working days prior intimations given for alteration in rights and privilege of holders, for financial results, for fundraising by way of non-convertible securities, and any other rights and interests that are affecting the non-convertible securities. And intimation to be given 1 working day prior. The listed entity shall submit a certificate to stock exchange of the interest of dividend or principal becoming due for payment, and intimation of 7 working days prior to be given for certificate confirming the payment of interest for non-convertible securities and the details of all unpaid interest or obligation in relation to non-convertible securities at the end of the each quarter.
Harsh, just 1 point. The first one on that regulation 50 sub-regulation 1, this is prior intimation of the board meeting where we are considering these items.
Yes.
Yeah, and in that we have to exclude the day of the meeting and the day of the notice. So just a small addition. That is the intimation for the board meeting.
Yes, sir.
Yeah, that is right. The board meeting is to be held for considering these items is to be given. And 2 clear days should be available actually.
Yes, exactly.
Yeah.
Exactly, sir. Yeah, Harsh, carry on.
So also these are the prior intimation, that is disclosure of the security that is maintained with respect to non-convertible security. This is given quarterly, and annual report disclosure not later than the date of commencement of dispatch to its shareholders. And for record date intimation, it is given 7 days in advance. And there are website disclosures to be placed on website. There are also XBRL based compliances for a debt listed entity. All debt listed entity are requested to submit the following in the XBRL mode only. that is the credit rating, interest payment, redemption payment, default history. So all these items are to be submitted in XBRL mode only till further notification. Further, all listed entities are requested to file recorded details in XBRL mode only, in addition to the filing in PDF mode till further notification. So this is the electronic electronic platform for book building. So in order to streamline the procedure for issuance of debt securities on private placement, so this is applicable only to a private placement basis, and to enhance transparency to discover prices, SEBI has laid down a framework for issuance of debt securities on private placement through electronic book mechanism. So this is applicable to mandatory issue of through electronic book building if the issuer is in existence for 3 years or more. Then if the private placement is of rupees 100 crores or more, then it is mandatory to do private placement basis through electronic book building mechanism. And if the issuer is in existence for less than 3 years and that issuer is doing private placement, then they have to do compulsorily from electronic book mechanism irrespective of the issue size. So in short, if the issuer is in existence for more than 3 years and the issue is of more than 100 crores, then only it has to do from electronic book mechanism. And in case of issuer which is in existence of less than 3 years and such issuer is issuing debt securities through private placement, then irrespective of the issue size, he has to do from electronic book mechanism only, private placement. So it is so the issue of debentures can be done from electronic book mechanism, even if the issue size is not more than 100 crores. So it is optional. So the issuer can choose to do electronic mechanism even if the issue size is less than 100 crores. So the eligible participants in these are that is we call as the bidders who bids in this electronic mechanism are the qualified institutional buyers, that is the QIB, and any non-QIB investor which has been authorized by the issuer to participate in such issue on EBP platform. So these are the two eligible participants that take part in the electronic book mechanism. And one is a qualified institutional buyer and another is if the investor is a non-QIB, then the issuer has to authorize him to participate in such electronic mechanism.
So basically, qualified institutional buyer, or otherwise it has been authorized by issue, either of it.
Yeah, so madam, this is to take care of that private placement norms.
Right.
Indirectly.
And now secretary should not jump, अरे देखो complicate कर दिया.
The way Harish has brought out things, it scares me. So many things have to be done just to make a public issue of debentures.
It's a private placement, not public issue.
Even then, then.
If you are less than 3 years and if you are more than 3 years, but 100, the limit is there, then also.
So many things.
Yeah.
Harish seems to be on my side as far as complexity of a debenture issue is concerned. Anyway, please go ahead.
Regulator is trying to safeguard your interest by putting so many regulations.
But then I would not like to give my company this amount of pressure. I would like to borrow from persons who are willing to lend without asking me to take this type of independent director, that type of independent director.
Okay. I carry on.
Okay.
So the recognized stock exchange and the depository are to be identified to act as an electronic book building provider. So these are the obligations of the EBP. It shall provide an online platform for placing bids. It shall have a necessary infrastructure like office space, equipments, and other manpower and other information technology infrastructure to effectively discharge its activity on EBP. And it shall ensure that the private placement memorandum or the information memorandum and the term sheet and other issue related information is available to the eligible participant on the platform immediately on the receipt of the same from the issuer. That means it has to disclose the private placement memorandum and information memorandum to the eligible participants as soon as it receives from the issuer. And it has adequate backup, disaster management, and recovery plans are maintained to the EBP and shall ensure safety, secrecy, integrity, and retrievability of the data. The EBP platform, so provided by the electronic book building provider, shall be subject to the periodic audit by Certified Information System Auditor, that is CISA. So the the intermediaries have to go through an audit by CISA.
Participants, sorry, but you can ask the question. We don't enjoy just one way. So please, even though it will take time, please, you can, again, I am taking my words, you can ask the question, Secretary. Yeah, Harsh, go.
So this is now we are going to discuss about something about the commercial papers. And
Harish, before you get into commercial paper, have you shown a slide requiring the company to keep aside funds into earmarked securities? There is something like that, no, that has been introduced, that you were compulsorily to keep aside funds, that is create a debenture redemption fund as against a debenture redemption reserve. Is there or is there not?
It is there, sir. It is a part of the debenture redemption reserve which you have to mandatorily invest in eligible securities, which more will be on the government security side, basically risk-free instruments.
But did Harish cover that?
I don't think that is covered. I think it was a talking point,
Okay.
but not covered today. Yeah.
Then the point which I want to make is that the various debenture rules provide for creation of a debenture redemption reserve, and that is up to a maximum of 10%. I'm on this debenture redemption reserve. I'm of the opinion that this debenture redemption reserve is of no use. It is of no use because you are not creating setting aside cash or setting aside funds to redeem your debentures. It does not give any great protection to the debenture holders. You are keeping aside 10% of your profits and creating a debenture redemption reserve. If the company faces a very, very bad period and is not able to realize its assets, or its assets realize very poor monies, how much of debenture redemption reserve you may create, the debenture holders will be at a loss. The real thing to be created is a good amount of setting aside of funds by way of eligible securities. That would be the real thing. And creation of debenture redemption reserve only restricts your ability to pay dividends. I think this 10% business is of no use. Open for discussion. I'm not, it is my view. What happens is, suppose a company has issued debentures of 10,000 crores, a large company, which means that it has to set aside 1,000 crores towards debenture redemption reserve. I'm saying that it is one of those companies which is required to create a reserve, which means that if you have got a profit of, say, 3,000 crores in a year, you will, according to your dividend policy, you will most probably keep aside 1,500 safely as debenture equalization reserve or something like that. And then 1,000 rupees is gone for this. So your ability to pay dividends is very much reduced. At the same time, there is no great protection given to debenture holders.
Sir, I think we are forgetting the security created in the entire conversation.
That's what I'm saying. How much of security is to be created? That was my first question.
Sir, 100%.
No.
At any point of time.
No, security created. That security created, Ankur Bhai, is on the basis of the assets. But,
correct.
But if in bad times those assets are valueless, what would really be something is if you keep in eligible securities. If there's a huge fraud in the company, all your assets will just collapse. But if you have kept it in government securities, that's a different matter.
Yeah, so this debenture redemption reserve, a portion of that has to be mandatorily invested in government securities. A portion of that. So that is the bare minimum amount which will be available for redemption. So it's a security mechanism mandated by the government only. Now, I will also indirectly answer your prior question of the benefits of a debenture over a bank. Sir, you will also agree if the company is in a really bad
Ankur
position.
bhai, wo jane do.
Yeah.
We have discussed that too much. Forget that.
No. So only one point, sir. Only one point, sir. Given the liberty, sir.
Yes,
Sir,
yes, please.
Yeah. In case of a debenture, the debenture holder is the limited crowd which will be affected in case of bankruptcy of the company. But in case of a bank, it will be a general public at large. I hope you get my broader point now.
Yeah, I get the broader point. Yes.
And in case of a bank, the government is also equally technically little bit responsible if it is a PSU.
Correct. Especially if it is a public sector.
And newspapers will not save any skeleton basically in that. In case of private NCD holders, let the buyer beware.
Yeah.
Wrong statement to make, but I'm just giving a broader idea, sir.
I agree. But coming back to debenture redemption reserve, I think it's of no use. And it only creates problems.
Sir, it is just a small liquidity portion left. Because sir, if the percentage is more, right, then what's the use of issuing debenture? If half of the money, for example, if half of the money is to be kept aside and invested in a GSEC, why on the earth I will go and issue debenture? I will go only for a bank borrowing.
No, Ankur bhai, you are absolutely correct that you cannot keep aside too much money. But let's not talk about the securities being created and kept aside. But creating a debenture redemption reserve helps you in no way. Once the company collapses, gone. So why have it?
Sir, by creating that reserve,
apart from restricting the payment of dividend, but then it does not restrict your putting money into creating new capital assets. So as far as your liquidity is concerned, you could be in the same position.
I think according to me, the debenture redemption reserve money which is actually transferred to DRR is really required to be invested. The total amount which is actually invested should equal to the DRR. That is what I understand.
Then just put it into the investments. Why do you want to debit your P&L account with an amount of debenture redemption? Just have one entry.
No, because the debenture redemption reserve categorically says it can be used only for this purpose. No other purposes.
I'm going to the root of the things. I'm saying that if you just remove debenture redemption reserve and instead you say create trust securities or eligible securities, your accounting entry will be eligible securities debtor to bank. Whereas in the case of debenture redemption reserve, your entry is P&L account debit to debenture redemption reserve.
Basically, you are telling don't create reserve, create security, make it available for debentures at the time of redemption, whatever 10%, 5%, 2%.
Yes.
Sir, I have answer for that. Sorry, ma'am, I have answer for that. Sir, basically, the corporates with which I have worked in the past, we are also holding government securities other than what is mandatorily required for DRR. Now, if I'm holding as an investment and if I'm made to hold as a portion of the debenture redemption reserve, where will be the separation line be? That's why it's just an accounting entry, it's a book entry, you understood that. So basically first a DRR to identify the amount of the DRR, and that amount has to be invested in GSEC, which has to be unencumbered. So it's just an accounting entry. Now to separate the company's ordinary course of investment and the company's investment requirement for debenture redemption reserve, this reserve comes in picture, sir. That is my little limited understanding. So that there is an identifiable asset. Tomorrow the company may say, "Ye to investment tha. It was not for debenture." We know how promoters are.
No. You identify those investments for the purpose of debenture redemption, but don't create a debenture redemption reserve and
I will suggest to MCA that DRR is useless rather than fix the government security.
I've been suggesting this since the year 2005.
Okay.
2000, they do not understand this, that a debenture redemption reserve does nothing. If the company goes fat, gaya. And it is only restricting the payment of dividends. That's all. It is not restricting the outflow of funds You can easily give loans out of that, out of the money. You can make capital asset investment.
So then we will write it and again create another round.
Maybe the main object of regulator is to just ensure that if there is everything goes wrong, then debenture holder should get money prior to the equity shareholders. So that is why only restriction is done to the payout of dividends. So this is created with only that intention. There is no other intention.
But
so
that
that is
will
why it
always
is like
happen,
that.
no? In
I think
priority
we
of
should, I think we should end here, otherwise
Okay.
we will not have it.
Okay.
Yeah.
Okay, we can proceed further.
Go ahead.
So now we will be discussing another debt instrument, that is a commercial paper. So these commercial papers are governed as per RBI guidelines, and issue is governed as per the RBI guidelines, and the listing of commercial papers is governed as per the new SEBI NCS regulation. So a commercial paper is an unsecured money market instrument issued in the form of a promissory note. So a commercial paper is a money market instrument, first of all, and it is issued in the form of a promissory note. So, and it enables a highly rated corporate borrowers to diversify their sources of short-term borrowings and to provide an additional instrument to the investor. So these commercial papers are issued by a corporate to satisfy their short-term funds need. So if a company is in need for funds for short-term financing, so rather than taking loan from bank, short-term loan, it can issue commercial papers for satisfying its short-term need. And commercial papers can be issued in the denomination of 5 lakhs and multiples thereof. So the face value of one commercial paper would be 5 lakhs and in multiples thereof. Maturity period for a commercial paper would be minimum 7 days maturity and maximum 1 year. As it is a money market instrument, the maturity cannot exceed 1 year. So CPs may be issued to individuals, banking companies, NRIs, and foreign institutional investors. So if a CP is issued to a foreign institutional investor, FEMA regulations also comes into picture. So companies, primary dealers, and financial institutions are permitted to raise short-term resources under umbrella limit fixed by RBI. So RBI has fixed an umbrella limit that beyond this, commercial papers cannot be issued by companies or financial institutions. It would be decided as per RBI. Eligible corporates that are to issue CP are that is the eligibility requirement for a company to issue commercial paper is that it should have a minimum tangible net worth of rupees 4 crore. A company has been sanctioned working capital limits by banks and financial institutions. That is, a working capital loan is sanctioned by any bank, and the borrower account is classified as a standard asset by bank or financial institution. So standard asset means that a company is paying its loan obligation properly, and if it would not pay its loan, then it would be classified as a non-performing asset. So a non-performing asset company is not eligible to issue commercial paper. It should be the account should be classified as a standard asset by bank and financial institution. So these are the eligible company to issue CP. So this is the procedure to issue CP in brief. That is to appoint an issuing and paying agent. That is a scheduled commercial bank. A company has to appoint a scheduled commercial bank as an intermediary that would guide a company to issue commercial papers and do all the procedural work. So, and another step would be to disclose to potential investor its financial position as per standard market practice. So then another step would be the company, the issuer has to disclose its financial position to the prospective investor and disclose about the financial position of the company so that the investor could issue in its commercial papers. The another step would be issue physical certificate to the investor or arrange for crediting the CP to the investor's account with the depository. So commercial papers could be issued physically also and could be in electronic form also. If they are issued physically, then physical certificates are to be given, and if they are issued electronically, then it is directly credited to the investor's depository. Another step, last step would be investor shall be given a copy of IPA certificate to the effect that the issuer has a valid agreement with the IPA and the documents are in order. So the investor is to be given an IPA certificate at the end. So this is how listing of commercial paper is done. That is as per SEBI NCS regulations 2021. So issuer has to forward an application for listing along with the following disclosure. That is, the procedure is very simple. They have to given just an application for listing, and these all disclosures are to be given to the stock exchange. That is details pertaining to the issuer first, then the material information, then the details of the borrowings as on the last quarter, and the issue information and the financial information is to be given along with the listing application. And this is the procedure for listing of CP on stock exchange.
Okay, first there is a question that whether stamp duty is applicable on commercial paper, and if yes, at what category?
Yeah, so basically now the stamp duty is a fixed percentage and it is has to be paid to the depository participants itself at the time of the issuance. The amount is not very high. It's it's some few paise only. And I think
Okay.
in line with the NCD issuance.
Okay, okay.
It's an instrument, so obviously stamp duty will be there. Government will not take away their pound of flesh.
Suddenly, 1.5 years back, there was an increase in the stamp duty for issuance of the commercial paper. Somewhere around November 2019, around 1.5 years back.
Yeah, it was rationalized basically. Earlier,
there was a drastic increase in the stamp duty of commercial paper. And just for information, yeah.
Okay, any questions, participant, please? I think people has asked the questions. Everyone is interested in PPT. So, okay, we are able to rather complete before time. Generally, we complete by 1 o'clock. So, thanks, participant, and thanks, panelists. I will request panel, both the panelists, they want to add something to what is presented, their experience or as such. They can share it. Mr.
Okay, I would
Ankur,
like to
yes.
I would like to add one thing with respect to public issue. Actually, in last 2 years, I handled various public issue amounting to aggregate amounting to 5,000, 6,000 crores. So what I understood is that the process is quite simple when we follow all the provisions and all the rules and regulations. We have a prospectus, we have a draft self prospectus open for SEBI for counts of 7 days, then we have a prospectus, then we have a trans prospectus. But one of the most crucial thing and very small thing, but really crucial thing is that ROC emphasize on signature of all the directors on the single page, which is a last page, which is attached with trans prospectus and self prospectus. I really don't know how to comment on this, but it is really a crucial thing. Like if there are 5, 6, 7 directors, and if even a single director signature is missing on the last page, you will have a nightmare at ROC office. I really don't know why they do this, but this is something I have faced a practical issue 4 to 5 times. And also when you have a public issue, when you go to ROC for the approval, better you ensure that all the forms filed with ROCs are approved. If even a single form is not approved, which is not even relevant to your debenture issue, even though you will have a nightmare over there. So this is something, a practical point which I have faced 3 to 4 times in different ROC, Bombay, Kolkata, Chennai. So I just thought of sharing it. By the way, it was a very good presentation, Harsh, and I think all the points has been covered. Even after this, if there are any particular queries or any particular doubts, then we are definitely available. You can route the queries or doubts through Mehta and Mehta, and we will definitely read out and revert those answers. Thanks from my end.
Okay, so
Harish,
tell me, sir.
Harish has actually made a wonderful presentation covering all the aspects. It is actually such a vast topic, daily speaking. And he has gone into each and every regulation. He has put it very nicely. I would like to definitely compliment Harsh on the excellent presentation there.
Thank you, sir.
So just adding to what Yashesh Bhai has stated, even a public issuance is not that much a nightmare for the documentation work is required. if we go by that further, private placement is a breezer. Believe me, only one time we have to prepare the information memorandum. For the next issuances, it is just an update of factual information plus update of the financial information, which is so obvious. Everything has to be updated if you are going for an issuance, especially be it a private placement or a public issue. I will just like to add, of lately, SEBI has further strengthened all these processes as far as security, which is should be available at all point of time for the debenture issue. After the last 2-3 years, 2-3 big default which we have seen in very large corporates, believe me, they have made it cumbersome. But at the bottom of my heart, I can say it is a very welcome move, so that the interest of the debenture holders plus the basically our the impression of our country as a whole is saved at the world stage level, when we have so many FIs and PN notes being invested not only in equity but also in GSECs and all. After having all such tighter regulations, it definitely helps an investor to take an informed decision due to availability of information. And the trustee's role is made very stringent in these NCDs basically. And these are all very new regulations, as new as 1 year old basically. Since November 20, the security which is available is tightened for the interest of the debenture holders. These are my closing points, everyone. Thank you for our patient listening. Just to add, all the views made were personal in a professional capacity, nothing to do with the organization. What I think I take the liberty of Yashesh Bhai also, which he represents.
Sure. Thanks everyone. Thanks panelists.
Thank you, everyone.
Thanks Yashesh,
Thank you.
Ankur, Mr. Bala, and Suresh Bhai and everyone and all participants. Thanks a lot. Thanks a lot.
Thank you.
Thank you.